everybody. I am very excited to talk to you guys today about the potential longer term outlook for next year. I thought this was something that was very interesting that I came across back in October whenever I was doing some longer term chart analysis. And so I've been wanting to share it with you guys because a lot of you have been asking, when is the bottom of this market? When is a good time to potentially buy back in? And so, for that reason, I was, you know, wondering that myself, right? When are we going to see the bottom on this? When can I start buying back in shares for my kids' account or starting to look at trying to play more a bullish trend aspect on options again and things like that? And so I was doing this analysis and I came across this pattern that I thought was very interesting, especially the way it's followed through over the years. And so I wanted to share it with you guys so that way we could be prepared going into next year together on the possibilities that are out there, as well as some of the levels that we might run into. But let's dive into this, right? So, first off, to start this off, let's go to a yearly chart. For those of you who don't know, SPX can actually go all the way up to a yearly time frame where each bar represents an entire year. I actually didn't realize that until this year that it went up that high. And so that's part of the reason why I was initially looking at these longer time frames because I was just curious on what they looked like, how they looked versus my indicators. And of course, if I could get any sort of clue on the levels that we might be pulling back into or what could happen. And this is when I started to discover this very specific pattern that kept popping up um, every time it printed and how it kind of from a math standpoint mirrors one another. So let's dive in and talk about it. And I'm first going to start on the yearly chart because this is where I started when I came across this analysis. So on the yearly time frame, as you can see for this year, we are creating a bearish divergent bar. For those of you who are not familiar with this indicator, the divergent bar indicator is something I had Eric create for me, and it's one of basically it can help signal when you might see a higher high or a lower low within the next 3 bars. I usually give it 3 bars to follow through. And so on a yearly chart, right, we are attempting to make a bearish divergent bar for the year. And I thought that was very interesting. Now, of course, a bearish divergent bar and an overall bullish trend like we are in on a yearly chart is a counter trend signal. So it's one that may not follow through, or if it does, it might barely follow through with a lower low. And so, though that could be a clue to a stronger sell off, it doesn't give me the full insight I was looking for. An example, a couple years ago, back in 2018, for those of you who recall trading back then, we made a bearish divergent bar. It was actually, a pretty choppy year. We had some selling going into the close that year. And so, of course, the question might have been, well, do we keep going to the downside the next year or not? And in this case, we didn't, right? We actually bounced up, and the follow through for this lower low, which the low of 2018 was at 2346.58. So that was the low of the year. It did technically follow through with a lower low on the signal, right? So the bearish divergent bar did work out. It followed through on the second bar, right? I give it 3 bars to work out, which on a yearly chart would mean 3 years. So 2 years later was the COVID situation, right? And that brought back down the market. And the low of that year was 21.9186 So it did follow through compared to a low of 23.46, right over 100 points. But I wouldn't call that a very strong lower low follow through. And certainly from a yearly perspective, we basically went down, tested the 10, bounced back up, and actually made a very nice bullish divergent bar for the year. Um, and so, that one wasn't necessarily a good follow through. And maybe that's what we see this year, right? That's a possibility. But when I was going back further in time, I also noticed that right before the stronger move down in 2008 or the stronger move that we had down in the 2000s, that these two also had bearish divergent bars that printed right before it followed through with some stronger lower lows. And so when I saw that, I was like, I wonder if there's a way where I can try and determine whether or not it's going to be a year like this versus a year like this or like this if we get the bearish divergent bar to print this year, which as of right now certainly looks plausible, but this of course has been a very volatile year. So we'll still want to make sure the signal prints to determine whether or not we want to jump in. And a part of that is actually because if we do in fact bounce up stronger in the market going into the close this year, this bearish divergent bar actually also has the possibility of a bullish divergent bar. And I will say this, bullish divergent bars on the yearly time frame have excellent follow through for higher highs. So this is the first possibility if you guys want to, take a note here, right? The first possibility that I will give you is if this prints a bullish divergent bar into the close, I'll tell you right now, I'm going to look at buying, right? Whatever bearish sentiment I might have had, it's on hold, and I am going to start looking at buying back into the market. And the reason why is because bullish divergent bars on a yearly chart have an excellent follow through rate of not only getting that higher high, but typically seeing it follow through within the next year. Case in point, the COVID year, we made a bullish divergent bar, followed through with a higher high that next year. Back here in 2016, bullish divergent bar, very nice follow through with a higher high. Back here in 2009, right after we had the pullback down into support, bullish divergent bar had a higher high. And certainly, depending on the move, right, most of these had great follow through rates going into the next year, even with the pullback for where we're at now, still above the close that it was at currently in 2020. So if this creates a bullish divergent bar, especially if ideally, right, we don't close at the high of the year, which I think would be a real stretch, but who knows with this market. But if it has room to move up to test the highs, if not move higher, I will be looking at trades with broken wing butterflies around 4,800 to 5,000 or more and start stair stepping them up to play for a move higher. So that's the first possibility, is if this keeps bouncing into the close of the year and we make a bullish divergent bar, then there's a very good chance that we will get back to or above our highs. And I would even quote it to say within the next year, right? Because that's how good the follow through rate has been on these bullish divergent bars. And let's just go back in time to get a little bit closer of a view, which makes it hard when we go back this far. But here was a bullish divergent bar that followed through. Here was one, that one took a couple years, but it did follow through with the higher high. There was one, it technically followed through. Obviously, these are much smaller bars. We are at much smaller price levels, but they did all, in fact, follow through with a higher high, and the majority of them followed through within the next year on immediately seeing that follow through on the higher high. So that's the first thing that I'll be looking for, right, is whether or not it makes a bullish divergent bar. But if it doesn't, and it makes a bearish divergent bar, then I would like to know whether or not it's going to be a bearish divergent bar I should ignore, basically. Not to say it can't follow through like this one did, but has that possibility where it barely follows through, or it may not because it's a counter trend signal, right? Or if it's going to be a bearish divergent bar where we do get the stronger follow through. So once I started to see this on my yearly chart, I took a step back and I went to the quarterly time frame to see if there was any clue on the quarterly chart that could help identify whether or not it is going to be a stronger pullback like we saw in 2008 and in the 2000s, or if it's going to be a move like this, right, where it doesn't quite get the follow through. And I actually found a pattern, guys. And so that's what I'm here to share with you guys today, is this pattern, as well as the signal that I will be looking for printing to potentially use as a buy-in entry to play back to the upside. So the signal that I realized that could help determine whether or not next year we see more selling, and then we'll go through the math on how much selling that could be, comes from the underlying price versus the 10 period simple and how it relates to the compound breakout tool. So, as you can notice, currently we are trading below the 10 period simple on the quarterly chart. We also have a valid pullback signal printing on the compound breakout tool. And the pattern that I started to notice is that if the compound breakout tool remains valid, and while it is valid, the underlying price closes below the 10 period simple for the quarter, then there is a very good probability that that selling will continue into the next year, right? Or technically into the next few quarters, which in this case will be into the next year because this is the last quarter for the year. Now, currently, we are right at that decision point. And it doesn't mean that we can't trade higher and then pull back down into the close, right? That certainly can happen and still create a valid signal. So what we will want to watch for into the end of the year, whether or not we keep bouncing shorter term, right? November into December and then maybe sell back off, is we will want to see if the underlying price is at, I would really be looking though below the 10 period simple, which currently, this has been moving around a little bit, but currently it's at 4,036.82, right? So there's another note that you might want to jot down in your notebook if you're not somebody who tracks the 10 period simple moving average, is that currently, and this, like I said, it adjusts itself depending on the underlying price, of course, but currently it's at 4036.82. So if we close below this by the end of the year, then it will confirm two things. One, it will be the second bar that closes below the 10 period simple while the compound breakout tool gives us a valid bearish signal. And this is what I am looking for to see if we get more selling. For example, back here in the 2000s, remember how I mentioned that that was a bearish divergent bar? But let's see in 2018, but it didn't really follow through the way that I was looking for compared to 2008, 2009. Well, let's see. Did the underlying price in 2018 break the 10 period simple? It technically did on the last quarterly bar. So there is that. But did it get a second bar to confirm it? Nope. That next quarter, we bounced back up, went right back above the 10S support, and the bearish pullback signal that we had, that was all that it was looking for, right? It moved down, tested the ATR trailing stop, held the 10 basically, and then it canceled out within the next bar. So this means that that bearish divergent bar on a yearly chart was one that I wanted to ignore, right? It didn't give me the setup on the quarterly for that confirmation that it could continue to sell immediately into 2019. So it's not one that I would have taken, right? It wasn't a valid signal. So that kind of helped clear up the noise off that yearly chart. Let's take a closer look now into the 2000s. Let me zoom out just a tiny bit and then I'll zoom in here. There we go. So here, let's start with the closest time frame and work our way backwards. So here's 2008. Now 2007, like I mentioned on the yearly chart, made a bearish divergent bar, right? So once it started to create that bearish divergent bar, it was time to say, okay, how do we know that further selling can really continue to the downside, right? What's our confirmation? And so we came here to the quarterly chart to see if we got that confirmation for further selling. So there was 2007. Then going into the first quarter of 2008, the price broke below the 10 period simple and closed below it. And at the same time, started to make a valid pullback signal on the compound breakout tool. We want a second quarter to confirm this setup, and we got it here. The second quarter also closed below the 10 period simple and still had a valid pullback signal. Notice that from a quote unquote intra move on the quarterly time frame, the bar technically tried to break above the 10 again, but ultimately failed. And so that's what I mean by I don't care if we trade a little bit higher than 40.36. All I care about is whether or not we close at or below, ideally below that level into the end of the year, if I am looking for more selling into next year. So that was the signal, right? It was confirmed down here. And then what happened? We sold off. We sold off for 3 more quarters. And more importantly, and this is where we'll go into a bit more detail here a little bit later in the webinar, but more importantly, the biggest move down from where this printed, not from the high of this move to the low, but from where the signal prints, the close of that bar on the signal to the lows, the biggest range of movement happened in the second quarter following that move. And that it's pretty clear in 2008. Like you can't visually argue that. Um, and we'll go into the math here a little bit further on, but just make a little note of that, that it's technically the second quarter after the signal prints where you usually get the biggest range of movement for whatever selling is left in the market. So that's one thing to note, and we see that there. And then we eventually found support. The lows came in that third quarter, and then we started to bounce back up. Let's move on. 2000, we had that bearish divergent bar that printed. Okay, well, let's see if we can get confirmation that more selling could continue. Well, into that next year, we actually into the close of this year of 2000, it broke below the 10-period simple into the close of that bar while printing a pullback signal. So this started the signal and it confirmed within the next bar. The next bar definitely closed below the 10-period simple and the compound breakout bearish signal remained valid. So once again, this clued us in that we could continue to see more selling. And we did, right? In this case, we continued to sell off for about, let's see, 1, 2, 3, 4, 5, 6, 7. 7 more quarters until we got to the low of the move, and then we start to bounce back up. If you go back and do the math, though, this is what's really interesting. The biggest range of the remaining move from the close of this bar where the signal is valid and prints, right, to the low, the biggest range happened in the second quarterly bar after the signal prints. And most of the time, and we'll walk through it, right? But most of the time, the second quarterly bar opens at the high of the quarter and sells off. Doesn't necessarily close at the low, but it opens at the high and then it sells down, right? So that means for us who might be looking to get bearish, at the start of the second quarter next year, if this signal is valid, that's when we might want to, look at putting some capital out there to start playing this to the downside. And I'll talk about the ways that I'm looking to do this while still keeping my risk very small, but still allowing for some excellent profit potentials. So that followed through, right? That signal was valid with the close below the 10. The bearish signal in the compound breakout tool confirmed it, and then we sold off for a stronger move lower. Let's keep going though. Let's go back to the 1970s, right? Because as you can see, as we zoom out in time, from a quarterly standpoint, we don't break the 10-period simple very often, right? So every now and then it looks like it tried to print to signal, but it didn't quite follow through. And a part of that is because, like here, for example, in the 80s, it technically closed below the 10. You could argue this closed below the 10. It had a valid setup. So you might be asking, Allison, well, there's the setup on the quarterly. Why didn't it follow through for a move lower? And the clue is that we didn't print a bearish divergent bar. So you want that bearish divergent bar to print and be valid on the yearly chart to then go back and look at the quarterly time frame to say, okay, now let's look for the quarterly setup. And if that works, then we get the selling. And so I've gone back definitely and looked at all the years that basically I have the compound breakout tool valid and the signals. And like I said, it's worked out quite nicely. So now we're going back in time to the last time we printed a bearish divergent bar on the yearly chart as this was setting up, and that was in 1973. 73 to 74. So 73 printed the bearish divergent bar, and so we're looking to see if the quarterly chart gave us the signal to clue us into more selling. And so here, right, it started to dip in 73 below the 10, and it started to give us a bearish signal, but then that next bar canceled it out. So we wait. And then the last quarter of 1973 definitely closed below the 10. We got a valid signal again for a pullback on the compound breakout tool. So we want to make sure that the second quarter also prints and remains in that setup, which it did. The second quarterly bar remained below the 10-period simple, continued the setup, and then we sold off a bit more strongly. And for that remaining move from the close down into the lows, that second quarterly bar had the biggest range. And then there's one more setup. Now this one followed through on the same way on the quarterly charts. And if, I had a DeLorean and I went back in time to do hindsight trading, I personally don't know if I would have taken this setup because it technically, unlike all the other ones where there was the valid yearly bearish divergent bar that first gave us the clue to look at the quarterly, 1970, 69 into 70 did not technically create a bearish divergent bar. So keep that in mind as I go through these numbers, but the quarterly setup still followed through the same way, which is why I'm still highlighting it here, where we closed below the 10-period simple, right? We had the valid signal on the compound breakout tool. I didn't count this bar because it technically remained above the 10-period simple. So that to me wasn't a valid signal. Notice the close of it remained above the 10. So I started the count from this bar where it definitely confirmed a break below the 10, a close below it, and then this signal, of course, on the compound breakout tool was still valid. And so it followed through here. And then what happened? We saw further selling. And more importantly, in that second quarterly bar was the biggest range for the remainder of the selling, right? And at this time, it actually happened to coincide with the low itself. That's not always the case, but that time it was. And then eventually, right, we bounced back up. That's it though. So let's make that clear, right? This signal does not print very often. And it makes sense because obviously I'm looking at very long time frames, quarterly and yearly charts. And from that standpoint, it's not like from a yearly perspective, we necessarily get a lot of bearish divergent bars in and of themselves. And the ones that do try and print, like there was one in 94, right? So let's go back to the quarterly time. Let's go check out 1994. 94, there we are. Did it ever break below the 10? Nope, right? There was no close below the 10-period simple that year at all. Even though we did technically have the bearish signal, there was no close below the 10, certainly not a follow-through bar to confirm it. So it was never a valid setup, right? So keep that in mind that, this is a setup where it may not technically work out, right? We always got to understand that. But it certainly makes for a very interesting chart pattern, especially when I break down the numbers, which I'm going to here in a second. So just to reiterate what I've talked about just now, to summarize it, the signal that we're looking for to potentially see further selling into next year, specifically to see a big range in the second quarter of next year, because that will be the second quarterly bar from where this signal potentially prints, right, for what we're looking for, if it prints at the end of this year. Then what we want is we wanted a yearly bearish divergent bar, and we want confirmation on the quarterly chart of a break and a close below the 10-period simple for not one, but 2 bars with the compound breakout signal giving us a valid bearish signal on top of it, right? So we want that in line. If that is in line, then there's a good probability that it could follow through like it has the few other times that it's done this setup, and in turn, right, get that stronger selling into the second quarter. And like I mentioned, the setups tried to show itself a couple of times respectively just on a quarterly chart. Like here, for example, it technically closed below the 10. Here, it technically stayed below the 10 at the close with a valid signal, but you never actually had the bearish divergent bar the year prior that told you, hey, this could lead to further selling the next year. So it was never a valid setup that I would have wanted to look at itself, right? So keep that in mind. Let's go now and do the math, because this is what I found really interesting when I was breaking this down. So back to 2008 here. From where this second bar printed, we closed the bar at 1280. And if you just want to confirm, right, look up here at the C is for close. And you can see when I highlight that bar, we closed at 1280. The remaining move from 1280 down into the lows, right, to the very low of the move, which was $666.79. The difference of that was and I have it in my notes here, a $613 move and 21 cents. So that was the remaining move lower that we had from the close of this bar to the lows. Not from the highs, but from the close of where the signal is valid into the lows of the move. And that ends up being around a 47.9 move, right? That's how much, 47%. From here, it was a 47% drop to get us into the lows. From the second bar that printed after the signal, right, the second quarterly bar, very clearly you can see that this was the biggest quarterly range of the remaining move. This range on this quarterly bar was $426 and a penny. And once again, you can see that up here next to the R. R is for a range of the bar, for those of you who don't know. And so that range was $426 and a penny. That, compared to the $613.21 drop that was left from the close to here, that range made up 69.47% of the remaining move. So just shy of 70% of the remaining move happened all within this quarterly bar, right? So the move itself from the close was about a 47, just shy of a 48% drop. And the remaining move in that second quarter, 70% of that remaining move happened here basically. So let's keep going. Back here in 2000, we got the valid signal to print here on the close of this bar. And the close of this bar was 1160.33. Now, unlike in 2008, where it continued to immediately sell off, in the 2001, we actually had a little bit of a bounce up that next quarter, right? So it's not to say that we can't look to immediately short at the start of the year. And I might actually look to do a little bit of that myself. But personally, whether it's a move like this or whether it's a move like this, I would still look to put more of my capital risk in at the start of the second quarter, because that has been the cleanest picture of we almost always open at the high of the quarter whenever the signal is valid, right? And we're looking for that second quarter, the biggest range. It almost always opens at the top of the range. So I know that even if it had a slight bounce like this, or even if it sold off like this, if I opened at the start of the next quarter, that the likelihood of it immediately seeing some sort of drop down for that biggest drop of the remaining move is strong, right? So I wanted to preface that you could look to start, if the signal becomes valid at the end of the year, you could start to look at putting a little bit of capital, immediately in January to play for the move down into summer. But I would just say, consider doing only a little bit of capital. That way, if you have to sit through a bounce that next quarter, like you had to in 2001, you're not losing and blowing out your account, and you still have your money mainly in play and ready to go for this quarterly bar. At least that's personally how I am going to look to do this. So let me get back into the math now. The close of this bar from where the signal printed, like I mentioned, was 1160 and 33 cents. 33, the magic number. The lows of the overall move was here. Happened a little while later, right? And the lows of that move brought us down to 768.63. That was the lows before we eventually started to work our way back up. So between 1160.33 and the lows at 768, the total remaining move lower was 391 points and 70 cents. So that was the remaining move, right? That's the math between the two. So overall, from the close of this bar into the lows, that $391.70 move was basically a 33.75% move from the close of the second bar to the lows, right? So in 2008, it was around a 48% move, and in 2001, it's around a 33% move lower in the market overall. This second quarterly bar, from where the signal printed, the second quarterly bar had a range of 295 points and 3 cents. That was the range of it. That range compared to the total remaining move of 391 points and change was a 75.32% move. So starting to notice some numbers here, right? This was just shy of a 70% move lower. This was slightly above a 70% move lower, 75% move lower. That happened in this quarterly bar. Now, once again, there's some differences here, right? This one immediately had the lows follow through within the next quarter and bounced. In 2000, it was gradual, right? We bounced back up a bit and then moved lower, and it took 1, 2, 3, 4, 5 more quarters from that big drop to still technically reach the lows. That's why personally, when I look to take this, I'm trying to mainly take the move here, if I'm playing the short side, if you will. So let's keep going, right? Let's go back to the 70s now. Let me go back. Oh, went a little too far. There we go, 70s. So 1974, we had that bearish divergent bar the year prior. We get the valid signal of the break and the 10-period simple, the close below it. We have the valid signal. So on that second bar that confirms the signal, where's the close of it? The close was at $93.98. 1, 2, that second quarterly bar, biggest move. You can see that pretty clearly into the lows that happened the next quarter. And then that overall point move from 93.98 into the lows, which were 60.96, was a $33 move and 2 cents. Now I know obviously that's not a lot, right? We're trading in like 4,000 range and this is in the hundreds, but focus on the percentage here for a second. The percent, right, of the overall move to the lows from where this quarterly bar printed was a 35.13% move that was left in the market, right? So the market dropped 35% more to hit those lows before bouncing back up. In 2001, it moved down 33.75% of the remaining market to drop. In 2008, that was the bigger one. That was 48, right? It's 47.9%. But you can see they're right around this 30 to 40% range that's left in the market. For the second quarterly bar that prints, right, this overall range of the quarterly bar was $24.37. That compared to the overall remaining move of $33.02 was a 73.8% drop, meaning this range held 73% of the overall remaining move lower into the lows. So once again, notice how that worked. 69.47, just shy of 70%, is what happened in 2008 on that quarterly bar. In 2001, it was 75.3% of the remaining move. In 1974, it was 73.8% of the remaining move. Notice how frequent it is around 70% of the remaining move that happens within this second quarterly bar. It's kind of interesting how it keeps playing out with that narrative. And then 1970, now like I said, and I prefaced this earlier, 1970 did not technically give us the bearish divergent bar. So I don't know if I would have ever traded this setup. But the quarterly signal still followed through the same way it did all the other times we did get the valid bearish divergent bar. So let's just talk about the move and the percentage. The second bar for the close and confirmation of the break was here. And the close of this bar was at 92.06. The low of the move actually happened within that second quarterly bar, and the lows was 68.61. So it was a $23.45 move, right? Lower that we had from the close of the bar to here, which obviously seems like nothing now, but back in the 60s into the 70s, right? That was a pretty big move. It ended up being 25.47% of the move. From the close of this bar into the lows, right? That was a 25% drop in the market. So just a little shy of 30%, but we'll make a note of it because we're going to walk through levels here in a second for where we might go into next year. So 25%, 0.47, we'll mark it. This bar, the second quarterly bar that printed, the range of it was a $22.09 range. Well, our remaining move was only $23.45. So you can imagine with a range at 22.09, this ended up encompassing 94%, 94.2 technically, percent of the remaining $23 move happened within this bar, right? That drop happened here. So what are the things that we can take away from this data point? And before I get to that really quickly, I had people ask me about this a while ago in the mastery when I first highlighted this analysis, and it wasn't as cleanly set up as I'm doing here. So I hope you guys in the mastery are getting a better idea of this now. But unfortunately, the compound breakout tool, for all the data that it needs to start printing on a yearly time frame, it started printing in the 50s for me. So unfortunately, I don't have the analysis to say, hey, would this have worked out in the 20s as well, right, for this downturn? Obviously, we know it closed below the 10, but I don't have enough data on the compound breakout tool to confirm this was a signal to play for that move lower. This is why I'm only focused on everything from basically the 50s on, and why, we had to gather first the data if we got the yearly bearish divergent bar, and then flipped over to this time frame to see if the quarterly bar prints the way it does to give us a clue on if we might anticipate more selling into next year. So what are the things that we can take away from the few times that we have had the bearish divergent bar print, and in turn, when it prints, have also had the quarterly signal set up for further selling? Well, the first point I take away from it is that from where we're at here, depending on how we close the year, we might potentially anticipate another 25 to 48% move lower in the market, right? That's what that first data point tells us. From the close of this bar and to whatever the lows are, could be anywhere between a 25% move lower in the market, or could be all the way up to a 48% move lower in the market if it's anything like 2008. So that's the first thing that we can take away, and we'll look at with numbers here in a second as we go through potential trade ideas into next year. The second thing to take away is that the second quarterly bar that prints after the signal sets up has a very good probability of being at least 69.47, if not more, percent of the remaining move, right, happens within that quarter. Technically 69.47 to that 94 percentile, but I would just average that together, and say 69.47, 75.32, 73.8, maybe 94. But as you can see, the majority of them are right around 70%, right? So we can roughly anticipate maybe a 70% remaining move happening specifically within the second quarter of next year. So for those of you who are maybe a little bit more math challenged, or you're like, Allison, you're throwing a lot of numbers at me, how does that help me for today? Well, what I did when I first found this out is I basically told myself, okay, if we close here, what would a 20% drop look like in the market? What would a 30% drop look like? What would a 40, a 50% drop? And then from there, depending on what that point drop looked like, how much is 50% of that move? How much is 60% of that move? AKA, how much is 70% of that move to what we might be able to anticipate what we could see in the second quarter of next year, basically. So my math was based on this back in October. And back in October, we were trading at 35.85. So we're nowhere near that level now. Let's go off of where we're at now. May not be where we're at into the close, right? So we'll want to base this off the close of the bar. Please keep that in mind. We'll also, of course, want to even make sure that the signal's valid. If we keep bouncing into the close of the year, then this stuff won't be valid, right? We might need to shift back and see if we're actually making a bullish divergent bar for the year to play to the upside. But if this signal is valid into the end of the year, and let's say, just to keep math simple, we close at 4,000, right? Well, what's 25% of 4,000? 1,000. So on the low end, we might see another 1,000-point drop before we actually find a bottom in this market. From the close of this bar into whatever the lows are, the low end might be around another 1,000 points to the downside, which, in turn would put us right by the 30-period simple currently on the quarterly chart, so it lines up from a technical standpoint. A pullback would also allow momentum to get a better reset. So I could certainly see all this happening from a technical standpoint, right? It makes sense that we could move back a little bit lower just to get off of these exhaustion levels that we've been at. So if we know that a 1,000-point move lower is possible, then what's 70% of this move, right? That could happen. Sorry, guys, not what I meant. Off 1,000, right? What's a 70% point move that could happen within the second quarter of next year? Well, that's pretty easy with the math, right? That's 700. So specifically within the second quarter of next year, it could be a 700-point move lower that we're looking for to happen within that range, right? And let's be more conservative. We know that typically we have seen at least 69.4%, if not higher. But maybe that's not going to be the case this time. Maybe it's only a 50% move, right? So let's say 500 points is what the second quarter of next year could entail before, it goes down to the lows. So there's that. Let's take a step back again. Say we close at 4,000, but we're closer to that 30% move. Because remember, 25% happened in 1970. The majority of the time, though, it was 33, 35, and then on the high end was the 48% with 2008. But let's kind of meet in the middle and say 33%, right? That's closer to the 2001 and the 1974 move. So times 33%, we're going to see another 33% drop in the market. That's a 13,200 point move. So keep in mind, if we close at 4,000 and in turn are below the 10-period simple, then from the close of this bar to whatever the lows could be in the market, if it's similar to a point move like we've seen last time, that's around 30-ish%, then it could be that we need to anticipate another 13,000 point move lower, or 1,300, 1,320 point move lower, right? Well, once again, what is 70% of 1,320? 924. So we might anticipate a 924 point range to happen within the second quarter. Once again, let's be a little bit more conservative, right? Let's say 50%. What's a 50% move? 660, right? 660 is what could happen within that second quarterly move. So I hope you guys are kind of getting the idea here. Yeah, TRL. It's not necessarily a pretty picture. I totally get it, right? That, from a market standpoint, it's not necessarily that I want this to happen, but I want us to be prepared for what might happen. And more importantly, ways that we might be able to not only trade the downside, but ideally take profits on the downside so that in turn, when we do get to a bottom, we can look to buy back in with that money that we made into shares and things like that for the overall reversal. Because bottom line is, we know just from this picture, the market doesn't just keep selling, right? Or at least it certainly hasn't. It has ebbs and flows to it. But the majority of the time, it is a bullish trend, right? This has been an overall bullish trend. And just like we talked about last year that we are at monthly exhaustion levels, well, we are certainly at quarterly exhaustion levels, arguably at yearly exhaustion levels. So with the higher numbers that we're at, would it make sense to get that kind of pullback and help things reset? Yeah. But would that mean that things are going to stay down there forever? No. More than likely, we'll eventually get back up to these highs. We'll eventually make new highs into a trend. That's the better probability. So, back to this. What we are looking for into the close of this year for whether or not this signal is valid is if this quarterly bar, aka going into the end of the year, closes below the 10-period simple. Everything else right now is valid, and I don't think this compound breakout tool is going to change unless we break back above the 10. Then it might cancel out, and either way, then the signal wouldn't be valid, so we would, just move on. But if we close below the 10-period signal, this will likely remain valid, and if that does, then we know we might anticipate more selling overall, but in particular for that bigger amount of selling, right, 70% good probability of the remaining move happening within the next quarter. Not next quarter, but 2 quarters, right? 2 quarters from here. So the second quarter of next year. And yeah, 2 closes below the 10, but it needs to also be in line with the compound breakout tool. So technically last quarter did okay, let me take a deep breath. The second quarter of this year did technically close below the 10-period simple, but the compound breakout tool was not valid. So I don't care. I need the compound breakout tool to be bearish and then for 2 closes below the 10 to happen for it to create that setup. That is what creates the valid setup. So the second quarter of this year did not have the bearish signal, so I didn't care about it. Last quarter did have the bearish signal and did print below the close. And more importantly, on the yearly chart, we are also attempting to make a bearish divergent bar. So if we can confirm the signal this year on top of the bearish divergent bar, that gives us a clue that that selling could happen into next year and be a bit more strong, just like it did here and here. And in turn, that second quarter of next year could be where the overall bigger chunk of that move happens. Sorry, Trader Momo. I know it's a lot. That's why I didn't want to do this during a room session, because I know I want to have time to answer questions, and it's a lot to get through in that sense with the math, right? It's kind of math heavy in regards to the analysis. But let's take it back now and say, okay, Allison, I've kind of heard your math. I kind of get the idea. What does that mean for me, though, going into next year? Well, let's look at some potential trade ideas, right? And obviously, I'm not going to open any of these now. I want to wait for the signal to be valid. And I also want to see where the close of the bar is so I can rework the numbers, right? But let's go back to that conservative viewpoint for a second. Let's say we close at 4,000, and let's say it is only 25% more of a market drop that we see until we hit the lows. That means it's an 1,000-point move. And let's still be conservative. And even though the majority of that second quarter typically is around 70% or higher, let's say it's only a 50% move this time, right? Not what I meant to do again. So 1,000 basically divided by 2, because that's 50%, we know is going to be 500, right? So it's going to be 500 points that could happen within the second quarter. So what does that mean for me? Well, it means that going out into the second quarter of next year, which keep in mind would be going into the end of June, right? Because the first quarter is from January to March. The second quarter, is from April to June. So June of next year, scroll, scroll, scroll. There we go, June. We can even do the quarterly expiration, right? We're at 4,000. Let's go 500 points out and start looking at some broken wing butterflies. So here's a 150 point butterfly. It's about a 1090 risk, max profit potential 8,900, with the idea that if we're on the conservative side, then maybe we get this pin going into the end of the quarter, or certainly we hit these strikes sometime between April and June. We want to keep it a broken wing butterfly because if we hit this level immediately and it's a bigger move like what happened in 2008, where we actually have a 40% drop overall in the market, and let's say it's a 90% move like what happened in 1970 that happens within that second quarter, then we want to make sure it stays a broken wing butterfly to still allow profit potential if this spread goes completely in the money. Another benefit about broken wing butterflies where the debit spread is wider than the credit spread is if this move happened in April, right? Let's say it immediately tumbles and our conservative mark is off and it's going to be one of those bigger moves. The broken wing butterfly still has a great chance of getting a profit on it immediately versus something like a standard butterfly where you really need to wait until expiration for that to be a bit more viable. And keep in mind, you can work on this however much you want the spread width. You could do something like this, a 50-25 point spread for $5. What I plan to do, ideally, is I want to do stuff like this, but I want to stair step them down, right? So there's 500. If it's a 25% move lower off 4,000 and we still get that 70% range, oops, sorry guys, that's not the math. So 1,000 point lower, right? Because that's 25% of 4,000 times 0.7 means it could be a 700 point move. So now I want to look at another butterfly around 3,300, right? And I could look to put one at 3,300. Obviously, the further I go out, the cheaper it's going to be and still allow for some really nice profit potential. Let's say that it's closer to that 35% move, right? So 4,000 times 35%, that's how much the market still needs to drop to reach whatever lows it's going to reach in whatever time. That's a 1,400 point move left that the market could see. Well, if 70% of that move happens within the second quarter, then I know that could be almost an 1,000 point drop from here. So let's go down to 3,000 and make another broken wing butterfly, right? And so the idea is I can stair step down some broken wing butterflies, some wide vertical debit spreads to maybe profit recycle, and have trades set up for that potential move lower within the percent range that we're looking for here, right? With if it matches up the ways that it has last time. And I'm not blowing out my account, right? 250, that's right within my normal risk tolerance for a trade, certainly in my smaller account, but it allows for some outstanding profit potential. And then if this selling starts to happen quickly, or we all of a sudden find ourselves at this strike well before June, the broken wing butterfly or something like a vertical debit spread would certainly still allow you to be profitable on the trade, even though something like a standard butterfly may not because of how that theta decay works. And if you want to do a standard butterfly because that cost is a lot cheaper, maybe do it a slightly wider spread, right? So that way if it happens, still excellent profit potential versus the risk, but it's still risk that is controllable. And usually the wider you make a standard butterfly, then it's a little bit easier to obtain at least some sort of profit if that move happened like the next day, right? So I hope that, kind of gives y'all a thought process. But that's the first thing that I'm looking at potentially into next year is, okay, if we do get the setup, then like I said, I could start building into some of these trades now, right, at the end of December going into January. But more than likely, I'll be looking to build into these trades at the start of the second quarter of next year in April. So that way, one, if I'm looking at a 700 point move down from April to June, right? It's not going to cost me as much as what I'm looking at now because I'll be a lot closer in time. I'm not out 220 days, I'm out like 100 something days, right? So the cost should get a bit cheaper on the broken wings. And then I can still place them at the proper levels accordingly to then play to the downside still. Um, so that's the first thing. The second thing I want to note about this presentation, and then I'll be more than happy to answer questions, is answering that very first question that I presented to y'all that I know that I've been asked a lot and I'm sure other traders have as well, which is when can I buy in, right? When can I buy? And what's interesting about these moves lower is notice the indicator down here. For those of you who don't know this indicator, this is my true low indicator. This is an indicator I created a little while ago. I did a whole bunch of back testing on. And the idea behind this indicator is it's not supposed to print for every pullback. It's not supposed to print for every low. The idea behind it is that it's supposed to tell you when a good discount price is in the market before a potential run higher. And as you can see on a quarterly chart, it does not print very often. On a monthly chart, it does not print very often, right? If I go back to a monthly and go to max time available, you'll see does not print very often. And when you zoom in here and look, I'll zoom in a bit more, you can see that oftentimes when these print, we're at the lows of these bigger moves. And so typically, when I've used this indicator in the past when I first created it, we were in a more bullish trend. So the market on the daily chart, let me just go back to Apple because this is a good example. I actually traded Apple last year with this indicator, 2 years. Let's just go 3. So you can see in a more bullish run, this indicator doesn't print very often, and it usually has good timing to where if you're considering buying in for either a shorter term or an overall bigger run up if you're buying shares, it's made for some good entries. I've traded options off this entry off the daily and weekly chart in the past, and they've made for some really great setups to quote unquote buy a low and play up towards a high. Same thing with a weekly chart. It doesn't print very often, right? The weekly chart had only printed twice last year, and I played this one for sure and played it up. The issue that's happening this year with this indicator on these lower time frames is that we are turning into a more bearish trend. So what happens is you get a bit more of a cluster print, what I call a cluster print like this, where Bollinger Bands are flaring open. And when that happens, it tells me one of two things. One, if I'm staying on this time frame, I really need the Bollinger Bands to flatten back out to help confirm that this is the best discount deal before buying in. And what I mean by that is to say that when it first started to print, it wasn't that this was a bad spot to buy Apple, for example, right? Obviously, $44 compared to where it is, great place to buy. But you had to sit through a little bit of pain first before that turnaround happened. And it arguably maybe wasn't the best discount price, right? This is like 25% off versus those Black Friday deals at 95% off, right? And so that's the first thing that I take into consideration is I need if I'm staying on the same time frame, ideally I need these Bollinger Bands to flatten back out. And then that helps clue me in that I'm less likely to sit through pain and can start buying in to play a bounce. Even if I don't buy in directly at 95% off, maybe I can still get the 75 or the 50, and then I don't have to sit through any more pain or seeing those, bigger sales. I can just keep playing it up, right? The second thing that clues me into, though, is that more than likely I need to take a step back and look at a longer time frame and see if I get the setup there. Notice in Apple this year, no true low signal yet, guys. We've had a overall decent pullback in Apple. No, there's no discount buy on a monthly chart yet, right? There's none. The last time we had a true low signal on the monthly chart was in 2016. Now, does that mean Apple didn't have pullback buys? Yeah, totally had pullback buys. But was it a great discount price? No. And that's what this is supposed to tell me. And I'm not saying it wasn't a great discount price, guys, but that's what this indicator is supposed to be. It's not supposed to tell me every low. I can see that visually just from looking at my charts. It's supposed to help determine when a really good place to buy in shares or to start building up longs and things like that could be. And of course, it depends on the time frame you're looking at. But because of all the selling that we've had this year, right? I have been waiting to see if this signal can pop up on the monthly time frame, just like it did back here. And if you guys recall and have been following along with me earlier this year on the monthly chart, it was this bar here back in May, it did start to flash a true low signal, right? It did start to appear at the lows for the month. But then what happened is we bounced back up at the end of the month in May, and that quote unquote discount price, it disappeared. It wasn't valid anymore. The signal was not valid. It did not print valid. And then what's happened since then? Well, we did technically get a little bit higher in August and followed through with that bullish divergent bar within that 3-bar rule. But ultimately, right, we've continued to sell off and we made new lows for the year. What's very interesting about this is that we have not seen any sort of flash print try and appear on the true low since then. It has not even tried to print like it did here in May, even though last month we were at the lows for the year. I did not see once where the true low indicator tried to appear. And the last time it appeared was in 2010, and that cluster print happened in 2008. So this to me is telling me one of two things. Either one, it's going to be like a COVID move, where maybe it does only print on the weekly chart, because I have started to see this signal on the weekly. So maybe it's just going to be a weekly signal. And if we do really start bouncing back up, then, these were the discount prices and I might need to start buying in to play higher, which, like I said, is why I'm going to be watching that yearly chart. If we really keep bouncing into the close of the year, then we might make a bullish divergent bar for the year. That's going to help me, at least from my confidence standpoint, help confirm that, okay, this was the discount price. I might have missed it because I was waiting for a longer time frame. Let me, look to buy back in while there's still some sort of discount to play to the upside, right? And that's what happened on COVID. COVID only printed on the weekly chart and then it bounced. My caution about thinking that way, though, is that even on the weekly chart for COVID, notice how it only printed a couple bars. It didn't give me any long prints like this, which is what I call like a cluster print. And when a cluster print happens, usually when you go back and take a step further back into a longer time frame, like this, we go from a weekly to the monthly, usually a cluster print means that you get the one-off print on the next chart, right? And so here on the monthly time frame, for example, we had cluster prints both in 2008 and in 2000s. Notice what happened on the quarterly chart. The one-off prints. And that's the last time the true low has ever printed on the quarterly time frame. Let's take a step back. Let's go to those 1970s, right? Oh, 1970. What was that? A one-off true low print. What was in 74? Up 3 bars of a true low print. Had all of them in agreement with that purple box. And those were the discount prices to buy in before the run up. And certainly from a bigger picture point of view, you couldn't beat buying in there. And you certainly couldn't beat buying in at the lows of the 2000 drop off and the 2008 drop off. Those were great places to buy shares for this market. Arguably, we have not seen discounts since then. So what I am cautious about, especially now that, I did this quarterly analysis and saw this, it's making me wonder, okay, if the quarterly signal prints, that could mean that there's further selling. If there's further selling, that could lead to the true low either printing on the monthly chart for a one-off print, or I might actually get a cluster print on the monthly chart, and we're looking for the quarterly chart to print the true low. And certainly if I get those signals, guys, I'm buying. I'm buying shares because for my kids' account, ideally, I'm going to start looking to go back long again on like leaps and calls and things like that, or playing, broken wing butterflies to stair step up into the next level of resistance. And when we break, you play into the next and so on and so forth. But you guys get the idea. So if you don't necessarily want to play the drop lower, I get that. I totally get that. For myself, I 100% want to though, because I want to use those profits to then buy in. But if you're just looking for when a good time to buy into this market might be, well, that's what I'm watching and waiting for, is to see if I can't get the true low to either print on the monthly chart or potentially even on the quarterly time frame, just given how the moves that did end up printing this quarterly signal worked out, right? Which is where we got cluster prints in the 70s and in the 2000s, and we had the one-off prints on the quarterly chart in the 70s and the 2000s for this move. Um, and so those are the things that I am watching. Now, like I said, if this really keeps bouncing up into the close of the year, if the quarterly signal cancels out, then I might have missed some of that while I was trying to be patient on a monthly chart because it already popped up a couple times on the weekly chart, right? And maybe I'm just, you know, being a little greedy or I'm being too conservative waiting, right? That could also be the case. And I'm prepared to accept that if that is the way. Because either way, I know I'm still not buying it, going to be buying it at the highs here, right? To play for a bounce up ideally, unless this market shoots right up to 4,800 into the close this year. I think I have a good chance of still buying a decent discount for a move higher. Might not be the 95% off, but I'll take the 30% off, right? To play for the move up. But that's also what's made me still cautious about buying in anything because you know, if the market does continue to sell off, then the probability of me getting a true low print on the monthly time frame is a lot higher. And once that true low comes in, especially, you know, if the Bollinger Bands aren't flaring open like this, if they are, then once again, either wait for them to flatten out to help confirm that that's the bottom, or like I said, go to that quarterly chart and see if it's printing on the quarterly to then confirm for that bounce up. But either way, that's what I've been looking for. We have started to see some true low signals come across certain symbols, like Amazon on the monthly has started to print some true lows more recently. Last time we got a true low here was in 2014. Right, let's just zoom in so you can get a better picture point of view. Because obviously those are discounts compared to where we're at now, but shorter term. How did that work out? Well, here did remain flat a little longer, but ultimately it had the run up. Here, overall had a short-term run up, and this was still a better place to buy than back here. So you guys get the idea behind the indicator, right? Here again, discount prices, that had a small run up. You would have had to sit through a little bit of pain on the second pullback, but this would have told you to, you know, pile in a few more shares and then certainly nice run up shorter term. And then of course, like I said, from that bigger picture point of view, you couldn't beat buying in Amazon shares at those levels before we've had the run that we've had here. The second clue that has been telling me to be a bit patient on buying in Amazon, because this is one of the shares I certainly want to buy in for my kids' account, is once again the fact that the Bollinger Bands are flaring open. Okay, they're flaring open. So I need to wait for one of two things. Either the Bollinger Bands to start to flatten out, so I know I'm not sitting through any more pain before a bounce up. Or two, is there a quarterly print? Nope. There's never been a quarterly print. So, you know, those are the things I'm watching for. So I hope that makes sense. And the reason why I personally haven't bought into things like Amazon yet for my kids' account is because ultimately, right, if the market is going to keep selling off, we can't anticipate that Amazon's going to ignore the market and be a honey badger. Not to say it can't. We've certainly seen plenty of honey badgers in the past, but it's going to be very hard for an individual company to, you know, fight the market and reach all-time highs when everything else in the market's dropping off. So I've been patient on buying those individual symbols, even though we have started to see some of them on the monthly time frame appear, because I haven't gotten anything yet that I'd like to see on the indexes themselves. And once the indexes start to print those signals, one, I could certainly look to buy things like SPY, right? Shares, buy shares of the ETF to play up and not have to worry about theta decay. Or I can then switch gears and look at the individual charts like Amazon or Tesla or Microsoft or Apple, and then, you know, confirm their true lows to play up. Because if the market's going to start bouncing, then I'm pretty sure Amazon and Apple and stuff are going to start bouncing with it, right? Or at least be able to hold up a bit better. So that is overall my presentation, guys. And I know I saw some of you guys ask about the indicators. I do have this little slide here. If you guys don't know, we have a deal right now going on in the Simpler Trading store for the holidays, which is 30% off. So that includes the True Low indicator as well as the class. If you use the code TURKEY at checkout, you can get 30% off of the True Low indicator. The sale ends 11/28. And of course, if you also wanted the class on top of the indicator, right? So you have a little bit more information about how the indicator works, how I like to use it myself, both from a daily perspective for whenever we get back into those bullish trends or for a longer term perspective. I made sure that both my indicator and the class have that 30% off deal so you guys can get it for a cheaper price currently. And then that way you can kind of prepare yourself going into next year. So if you're not, hopefully you're still here at Simpler trading with us. That'd be great. But if you're not, or maybe you're taking a break, or, you're like, Allison, I like this analysis, but, I don't really like your trading style. I trade huge accounts and blah, 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 right? Whatever. I don't care. This way, though, you have the tools for yourself. So that way you can look for the same things that I'm trying to look for. And if you find what you like, and certainly the indicators are showing you, hey, this is a good discount price to buy in at, that you have it available for yourself to do so. But let me answer at least some questions that you guys have. I'll try and scroll back up in the chat a little bit to see if there are any, and then I'll end it here for tonight. But this is analysis that, like I said, I did back in October, and I've been really wanting to share it with you guys because I just thought it was so interesting how that second quarterly bar kept being 70% basically of a move each time. And that, on average, we usually see low end 25, but usually around 30% or more of a overall market drop off continuing from the close of that quarterly bar, and how the 30% of that drop off, 70% of that move happens within that second quarterly bar, aka of next year. It was really interesting how that kept playing out the way it did. So I wanted to share that with you guys. And like I mentioned, it usually goes off the idea that we get the bearish divergent bar to print this year, and then the quarterly setup on top of that is valid. So the bearish divergent bar, at least as of right now, is trying to print on the yearly chart. So what we're really looking for is into the close of this quarter, do we close below the 10 period simple or not? And if we close below the 10 period simple, then that could be what leads to further selling, potentially a 30% further move to the downside in the market. And in turn, that's when we might finally start to see this true low signal pop up in the monthly chart, and could be a clue as to why we haven't seen it pop up in the monthly chart yet, even though we have seen further selling this year. So, and then Jonathan, the 2000 lows was brutal, just kept selling and selling and selling, then a rip and more selling. Yeah, similar in 2008. So exactly, that's why I thought this was interesting. Let me bring this back up really quickly on the chart, because keep in mind, like here, the 70s, right? Both of those moves, that move to the downside basically happened, and then the low was either that bar or the very next bar, and then the market bounced. But what was interesting, and arguably that was also 2008, right, where the majority of the selling happened here, the next bar made the lows, and then we bounced back up overall and started to try and work our way back into a bullish trend. Not to say it didn't chop and consolidate some, right? That's not out of the question. But overall, that's where it started to work higher. What was interesting to me, though, was in 2000, the math still worked, right? The close here, the remainder of the drop down, 70% of it happening within the second quarter, all of that still matched up. But technically, from this quarter drop to the lows, it still took what, like 4 quarters for that to happen, 5 quarters before it finally found a bottom. And so that's why I think it's really interesting to have this analysis here, because even if we don't know exactly when the bottom's going to happen, whether it happens immediately on that bar, whether it happens the next quarter, or whether it happens 5 quarters later, the consistent thing here is that the biggest point range of the remaining move lower consistently happens within the second quarterly bar after we get the confirmation signal to print. So that is why I'm saying, guys, I'm specifically looking to trade next year lower. Doesn't mean it can't continue to stair step down like it did in 2008 and then it's the big range. Could be that it happens in 2000 where we pop up and then we get the 70% move that happens for the remaining sell off. But no matter what, what's been consistent is that second quarterly bar from the validation of the signal has usually 69.47, right? Let's just round it to 70. It has basically a 70% move or higher, and it almost, right, always opens right by the high of the bar, and then it sells, right? The open of the bar is basically the high of the bar. Let's go back to the 70s just to show that too. High of the bar, sell, right? And that actually closed at the low of the bar that time. 70s, high of the bar was the open, sell, right? And it basically closed right close to that level, had a little bit of a bounce to hold the ATR trailing stop. But you guys get the idea, right? It sells that second quarter. So, I don't know if it's going to be a move like that. I don't know if it's going to be a move like 2000. It may not even follow through. Let's be completely upfront. The signal could print and then it still might not follow through the same way, which is ultimately why when I shared with you guys trade ideas, I'm trying to share with you guys trade ideas that are very low risk but have high profit potentials, right? 360. That's, probably inside most of the traders' risk tolerance here at Simpler on a one lot, I would say, even for smaller accounts. But notice that profit potential, right? If it goes completely in the money, still has a $50 profit potential for this particular broken wing. And so there are ways that we could still trade this downturn, have an anticipation of when that potential bigger move can happen, but still do trades that won't blow out our account, but on the flip side could certainly help grow the account quite a bit if the move ends up following through. And then, yeah, not a problem. I do have a video of what's on my charts and why for any of you guys that are curious for the other indicators. But the gold lines are my simple moving averages. They're the 10, 30, and the 100. The dotted line is the ATR trailing stop. And I just changed the visual on it so I could tell the difference between that and my Bollinger Bands and my moving averages. So, and there's no true high indicator. People asked about that when I first came out with the indicator in the class. And I did not create that indicator whatsoever to call tops. I usually only used it to call bottoms because, once again, keep in mind, this indicator was created not to tell every pullback buy, right? It's helped to determine when the best discount buy is. So, I'll have to take some time, but I'll take a look and see what the signal looks like reversed. And if it makes sense to have a quote unquote true high indicator, maybe it would have helped confirm that, this was going to be the top before market pullbacks. I don't know. But I do know that at least for the analysis that I have done for the quarterly chart, we need a bearish divergent bar to start forming on the yearly chart, which we have. And then we need the quarterly setup to follow through to help signal maybe a stronger low. Yeah, and I am a theater major, so math is, I've always been pretty good at math, but it's certainly not what I majored in whatsoever. So I did, for those of you who don't know, I majored with a BFA in theater performance at Stephen F. Austin State University down here in Texas. Studied a bit in Europe too, over in England and in Barcelona. But I started learning about options trading basically right after I graduated from college. When my dad started to learn options trading, he had done like covered calls and things like that in the past. And he was trying to get us kids to learn. And to me, it certainly sounded better than waiting tables, right? It sounded like a way I could fund my theater endeavors. And then when I started to learn how to trade, I just became hooked. It became like a second passion. So, but yeah, definitely not my background. So. And yeah, I would love to profit recycle down for the ride. So, but no, I don't have a true high indicator yet, guys. And Jonathan, very true, right? So even though we had these strong bounces, I do agree. It took about 5 to 7 years for the recovery to happen to get back to the tops, which is why I mentioned, shares might be, it's not to say we can't play the options higher, right? Because we can play them up into resistance and things like that shorter term, but we can't anticipate that it's going to be like a COVID move, right? Where it sharply drops and then it sharply bounces up. Technically, the move down here, that usually takes a couple years, and the bounce up, which takes, 5 to 7 years, the move happened down in a couple months, and then the bounce up actually happened within to like 5, 7 months. So the point, it's funny, right? Because the drop was dramatic, but if you just convert the years to months, it still kind of played out within the same time frame. Um, but we can still certainly look to play option trades to the upside. We'll just need to be mindful of our levels and targets as we play higher. And then for those of you who are like me that are maybe trying to build longer term portfolios, or you're just more of a stock buyer, then certainly, you don't care about when, how long it takes to get up because you bought in at the best discount price there was, right? For that move higher. Really quickly, just off that note, let's look at the 70s real quick. So this bounce, happened, and then to get back up to the highs, went from 73 to 80. So that was about 7 years. And then this one here for the 70-point drop, those highs were around 69. And we retested them in 72. So that one only took about 3 years. But you are right. More recently, at least off 2000 and then the 2008 move, it took about 5 to 7 years to get back up to the highs. And of course, Anne, always happy to share my work. I just thought it was so interesting. So I wanted to make sure to clue you guys in. That way, if you're curious about where we might go into next year, that's what I'm watching at least. So we'll see if the signal prints or not, and off the 10-period simple into the close of the year, and then we'll also wait to see if it looks like it's starting to follow through. And if it doesn't print, right, if we do really keep bouncing into the close of the year and we start to make a bullish divergent bar for the yearly bar, then you guys already know I'm looking to buy. Like that's already my confirmation of up. It's only the weekly chart that's giving me the true lows. I'm buying in because the likelihood of us getting back to the highs, that the all-time highs within the next year or higher, very strong if it's a bullish divergent bar for the year. So we'll see what happens. And then try entering minus SPX. You mean this, Mazer? I don't know if that's, oh, well, that's interesting. But yeah, obviously the true low signal is going to print a lot because it's a bearish trend and you would want to go to a longer time frame. So I don't know if we convert this to a true high, if it's really going to make much sense. But I'll play around with it if that's what you're trying to test out there. I didn't realize I could do that. But yeah, I wouldn't use the true low signal as a top indicator if that's the case. Pretty interesting how that works out. Now you're going to make me go explore that chart. Do some longer term analysis on that one. So, but did you guys have any other questions before I sign off here? Let me know. Yeah, exactly. Probably need some refiguring. And absolutely, John, the reason why the COVID move happened as quickly as it did is because it was an unknown unknown, right? Typically, the market doesn't like unknown unknowns. If you had asked anyone back in 2018, 2019, that the whole world would basically shut down their borders, that, shipping would be at a pause, that manufacturing could potentially be at a pause, certainly from an international standpoint, people would have probably laughed in your face and called you a conspiracy theorist, right? You would have been like blackballed and be like, that crazy person over there, because it was completely just, it wasn't even a possibility. And so to me, that goes into the category of an unknown unknown, where the probability of us even thinking about it is just too far out there. And so when the market confronts one of those situations, one, it can move very quickly, right? That's where that volatility comes in, because the market does not like uncertainty. The second thing, though, is I think that's why it also recovered so quickly, because once it started to have an understanding of how things were going to work, once it kind of had a baseline of, okay, how's the government reacting to this? Okay, are things opening back up? Is this as big a deal as we thought it was. Then once it kind of started to wrap its head around it, it started to bounce back up again, right? And so for that, it started to become a more known situation. So if we ever ran into a quote unquote COVID situation again where the world shuts down, I don't think it would act the same way it did in 2000, because at this point it's a known situation for the market. The market has seen a situation like that in the past, and so it has a better understanding of how it could, trade it, how it might affect for future years. And so it would probably be a slightly different move from how dramatic the move was back in the, 2020 when it actually happened. So it was one of those unknown unknowns. Yeah, I know, Ari. I'm right there with you. I am all for waiting for these Bollinger Bands to start flattening out, or for some true lows to start printing on the monthly and quarterly chart. I'm trying to be very patient. And arguably, being patient has helped me, right? Because when I first started to see the signal in May, I was like, maybe we even played a tiny trade in the SPY that we profit recycled, thankfully for a profit on this short bounce up that happened. But, I haven't bought shares in May or anything like that. And that certainly helped me out because the market obviously has continued to drop, and things like Amazon, right, made new lows. They broke 100 and stuff. So I'm not having to sit through pain on that very first print when those Bollinger Bands are still telling me to be patient. So, and certainly the market itself still has not printed it on the monthly chart, which is ideal. Because if I can start seeing it there on the quarterly, then that's certainly going to help me determine good discount. So I don't see any other questions coming in. Thank you guys so much for joining me. My chat was stopped really quickly. Yeah, the 70s wasn't the best. I don't necessarily want to sit through a whole bunch of chops. So if we could just pull back and then keep going in a bullish trend, I'm fine with that. I think most people would be fine with that. But I don't see any other, questions coming in, guys. So I do got to go handle the kids and prep for dinner and stuff. But thank you so much for joining me. I hope y'all have a safe and wonderful holiday week and market holiday for those of you who don't celebrate Thanksgiving internationally. And I'll be on a few room sessions tomorrow, but if I don't talk to y'all tomorrow or Friday, also have a safe weekend. And I look forward to talking to y'all again next time. Bye, y'all. Hey, Allison Ostrander here, Director of Risk Tolerance at Simpler Trading. Thanks for watching the video. If you enjoyed this video, please be sure to like and comment down below to help us out. Also, be sure to subscribe and click the bell icon so you can get notified when we release our next video. And if you want to watch us trade in real time using our own money, go to simplertrading.com to learn how to sign up. As always, may the trade be with you, and we'll see you in the next video. Bye.